Welcome. I'm Greg Brogger, the CEO of Collective Liquidity. Welcome to the first installment of what we're calling Collective Insights, a series of webinars where we will be bringing our community of executives and founders of leading venture-backed companies information about industry trends and about how to navigate those trends in a way that maximizes their wealth over the long run. Today, we're very excited to kick off Collective Insights with two stellar speakers. First, joining us is Phil Trahanas. Phil is going to share his thoughts on the current investment environment in the late stage venture asset class. This is a topic Phil knows a great deal about. He was an investing partner at General Atlantic for many years, and before that, a tech banker at Morgan Stanley. Phil, take it away.
Okay, let me see if I can successfully share a screen here. Did that work for everyone? Sorry, Greg, give me a nod if that worked. Thank you very much. Okay, yes, great. So,
your screen.
Perfect. Hi, everyone. Thanks for joining. As Greg mentioned, I've got a few years of investing under the belt, most of it in tech, but in later years also just in the broader sphere. And I think that relates to today's discussion a little bit because, you know, we think about late stage tech investing as its own thing, but in environments like the one we're in today, it connects in more than one way to interest rates, what's going on in real estate. You know, the capital allocation game is getting shifted in real time, and that affects us directly and indirectly in this asset class. I'm going to go through some of those macro observations and try to go through those quickly to get to the venture and growth equity environment itself. And then I also just want to make some observations on AI. Everyone's got an opinion, but I've got an interesting, I think, lens. And I'll describe why that is when we get to that section. So just to hit the macro for a little bit, before we talk about the specific venture or late stage growth equity area, it's interest rates, you know, and what is the nature of this big gorilla and what does it do to us? I probably don't have to recall for many folks on this call that interest rates were essentially zero, free money for many years. It worked our market in many ways, and now we're living sort of with the aftermath of that. And I just want to show the graph on the right. You probably can't see this in great detail, so I'll describe it. This is, you know, going back many, many years, the interest rate forward curve. And so what is this? This is the structure of interest rates on a forward-looking basis at any given moment in time. The solid line is where the Fed is actually moving the short-term interest rates to try to affect that. And the only message on this graph there really kind of looks like a mess because that is the message. It's a bit of a mess. And, you know, despite the fact that there are trillions of dollars being essentially bet on this market every day, no one's really right. And so why do I bring this up? Because, you know, for many years, we didn't talk about interest rates. They were low, money was free. We talked about a lot of other things. And now all of a sudden it's affecting, you know, can I get a new house? Can I get venture funding? And a lot of other related things. Will I lose my commercial office building if you happen to be an owner of one of those? And so the headlines are dominated with what will happen to interest rates. And the answer is no one knows. And please don't bet your future on someone telling you what interest rates are going to do. We entered this year with the experts saying we're going to have 6 cuts. Now we're down to 1 cut. And a lot of smart people are going, what cut maybe we should boost, right? And so the message is simply, they're important. They affect us. No one really knows. It's sort of sand shifting under our feet. And that kind of sets the backdrop for where we are right now. By the way, just maybe to date myself a little bit as an older guy, you know, 6% interest rates, they've kind of been the norm, right? Like for most of my life, risk-free interest rates were 5-6%. They weren't 0 and 1. And so the other message I think is maybe let's get used to higher rates. I'm not predicting I'm going to stay at 5 and 6, but you know, anyone looking forward to the zero interest rate environment again, you might be waiting a while. You know what that does is it creates a sort of racking and stacking of risk premia across all markets, not just ours. It's certainly happened in real estate in a very, very acute, painful way. And that sort of ripple affects it all its way through the public markets and then ultimately to the IPO market as well. And what it comes down to is professional, you know, money managers asking themselves the question, is it worth stepping into the IPO risk, right? Is it worth doing that? Am I going to get paid taking that risk? and they're having trouble answering that question for themselves, although there are some bright signs we'll talk about in a few minutes here. That means limited exits and no liquidity. So we're living in a market where, again, the professional fund managers that are investing from Series A, Series B, all the way to late stage growth equity, have some frustrated LPs. They're under a lot of pressure, saying, hey, I want my money back. It's been a few years. I need to see some liquidity. And by the way, you're sitting on commitments of mine, drawing management fees, and I don't see you putting money to work at a pace that makes sense. And so you've got frustrated LPs, you got GPs under pressure. Something's got to give. And so, I think we're headed to a more constructive environment where there is going to be some give and some unblockage. And I'll describe why that is in a bit here. Specific to our market, the backdrop is over the past couple of years, a fair amount of trapped value and in some cases even broken cap stacks. So, in the trapped value scenario, companies that raised money at an enormous valuation felt pretty good at the time. Of course, you're going to take that money at that high valuation. Why wouldn't you? But fast forward to today, less supportive environment. Those values might not make sense in today's environment, and so there's a little bit of a value trap there. Worse off if you raised a lot of money too, so that if you raised $1 billion across a series of Series A through Series H, and you got $1 billion of preference in your cap stack, maybe that was fine when you had a $4 billion enterprise value. If in today's market you're being valued at $1.5 billion, your enterprise value is a little too close to that pref stack, and that's a longer conversation for another day beyond the scope of this. But that's an even tougher situation if you happen to reside at that intersection. So, onto the venture/growth equity environment itself and our market specifically. So let me just start on a positive note. Winners do exist. They are out there. There's been a little bit of a barbelling of the market, but you can still find companies that are growing 30, 40% year over year. That might be a deceleration from 50 or 60%, but 40% growth is still pretty zippy growth. That's great. We're even finding some companies with, in great segments with great products and great management teams where they might have hit a little bit of a growth slowdown, but some of them are actually starting to reaccelerate. I don't see that too often, but you're actually seeing a little bit of that as well. There is a fair number of companies that are operating with 100 million ARR on up. We're seeing 300 million ARR companies, every now and again a 500 million ARR company. These are real companies. These would normally be public companies at that scale, and here they are in a private mode still. And so I'd say there's a backlog of scale companies, with some high quality characteristics. One of my favorite metrics to just kind of get to right off the bat is net revenue retention. It speaks to a lot of the health of a business, and we're still seeing companies with 120%, 130% NRR. And so that's very healthy and very encouraging. There is a supply of reasonable IPO candidates. Good news. Look, on the other side of the spectrum, we have, zombies and accidental unicorns, right? So an accidental unicorn is a company, it may be a fine company, but, got caught in that 2021 top tick, a bit overvalued. And it kind of became a unicorn by accident almost. And, in today's valuation environment, wouldn't enjoy that type of valuation again. We do see some companies that are so high quality and so high growth, they've actually kind of grown into that value expectation. You're very fortunate if you're there. They can justify their prior round value and maybe even a premium to that. And you do see that occasionally. But, you also see from time to time companies where you ask, will they catch up to that value? The good news there is, there's no longer a stigma, I don't think, to this idea of readjusting value. People recognize we kind of came out of this era where, look, you just got rewarded with high valuations, and maybe today it's not quite as premium a valuation. So I think you can live to fight another day through that in a funding round. The zombies are more difficult. These are companies that don't have as compelling prospects or business models, but they raised an enormous amount of cash. And we even saw this happen back in the 2000 era where you raised a bunch of cash. It's not a robust business model. It is loss-making, but a management team finds its way to sort of reduce the losses and extend the runway. And so there will be a fair number of zombies that sort of limp along for a while until their ultimate outcome, whatever that might happen to be. What's happening against all that is, a favorable environment for investors that's happened. as global venture funding has dropped significantly in Q1 of 2024, we're down 30%. China's down 40%. It's the lowest levels of funding since 2017. That said, fundings are happening in a bargain hunting kind of mode in many ways. So I think what used to be a Series B is sometimes a Series A now. The investors who are active, I think, are being rewarded with some pretty high quality companies coming up in that area. And investors are being very careful because they realize that they've got a book of investments that may not completely work out for them. So the next investment they make has to work. But as a result of this, I think you are going to see a pipeline of companies that grow out of this era into quite a constructive cohort, if you will. Years from now, we'll look back and say, boy, I wish I did more then. At least I believe that's the case. The exception to all this is sort of the AI frenzy, and is it a bubble? I don't know. We'll see. I mean, I think there's some real stuff in there for sure. I'll describe why in a minute. But there's definitely some things that are maybe putting an AI label on them that maybe shouldn't, and getting a premium for it. Overall, despite all that caution in there, I actually am positive. IPOs are creeping back. Ibotta got out there. They're still trading at a very good premium to their IPO price. If you're one of the institutions that went in, you feel rewarded. Rubrik, as we sit here today talking about this, Rubrik is just above its IPO price. I don't think that's a reflection on the company. Rubrik's a great company, but every IPO is a little different in this environment. And let's see what happens with that. But again, it's sort of this caution with IPO investors. They're not uniformly being rewarded along the way. And so we'll have to see what happens with what is a developing backlog of IPOs for the second half of this year. The rumored ones that are picking bankers and preparing their filings, Cerebras happens to be a portfolio company of collectives, ShipBob, Lineage Logistics, StubHub, and there's others. Remarkably on that list, there's 2 companies in the logistics area, which is remarkable, because if you think about what's happened to logistics over the past 12 months, both in the offline world and the e-commerce world, it's been turbulent. You've had some bankruptcies and some very stressed companies there. But I think, again, it's perhaps a sign that investors are being thoughtful and selective and saying, look, despite that, logistics is a really important area. And if you've got a company that's got an excellent product or service that's differentiated demonstrably over a period of years here, they're perhaps willing to embrace that. And we're going to find out later this year if and when those eventually click off. We will eventually see rate cuts, as the economy rolls over. Again, as I said earlier in the presentation, I wouldn't wait around for that. I mean, just to put that into perspective, Q1 of 2024, we're just off of that quarter a couple of months ago, and that was $7.2 trillion in debt issued by the U.S. government. That's the largest on record. To put that into perspective, that surpasses Q2 2020, which is when they shut down the U.S. economy and started funding it essentially during COVID off their balance sheet. So there's a huge amount of treasuries around there. So eventually we all go through these interest rate cycles. They will be cut. I think the message is just please don't bank on it. Finally, I'll just end by referring to these graphs on the right. These are from Michael Semble, a super smart guy, my favorite economist. He's at JP Morgan. And he talks about these graphs often to try to judge the health or selectivity of the IPO market in tech. And the one on the top is the market cap of what he calls YUCs, young, unprofitable companies in technology. And what he's demonstrating is that big peak is the 2000 bubble, when basically almost anything got public, whether it had revenue or not. Much less profits. And he's just showing how sort of outsized that got. And then as you watch the graph move forward, it sort of hits a trough and then starts building towards a local peak again. And then we head back down. And that's where we are today, which is basically, it's a very selective IPO market. And people are paying attention to, the fundamental economics and health of a company before letting it out into the public domain. Similarly, down below, tech IPOs, number of IPOs in the blue line, and that sort of gold line is the percent with negative earnings. And what you're going to see is, unfortunately, the IPO market is down. There's not many issuances. And it's also very selective in that, very few companies getting out with negative earnings. So you might say, wow, why does that make you positive? Why that seems like a negative message. It makes me positive because it means that the markets are selective. And if you link it back to what I said earlier, there are some really high quality companies. We know because we see them at Collective, right? We can see these coming in and have some fundamental data on them that are growing profitable. They got great metrics associated with them. They're operating at scale. And so if you have the intersection of companies that are ready to go public, deserve to be public, with a selective market, what you hope happens, and we'll see, is that investors are in fact rewarded by stepping into that IPO kind of crosshairs, that 2, 3, 4 IPOs go off, they're up 30, 40, 50%, 6 months out sustainably. And then institutional managers say, I cannot afford to not be in the IPO market. I can't end this year 200 basis points shy of where my competitors ended up because I said no to every IPO. And that's where you hope we're heading. I'm not going to make any bold predictions here, but it's got the backdrop to head in that direction. Investors need tech. Let me just give you 2 more stats before sort of getting to some thoughts on AI. Here's one, and let this really sink in. Cash flow margins for large cap tech companies are 3 times higher than non-tech. Let that sink in. That's a cash flow margin, 3x higher. That's if you take the entire tech market and compare it to the entire non-tech market. It is a staggeringly more profitable market at scale when these models mature. And so again, institutional investors realize they can't afford to ignore, the next batch of Amazons and Facebooks. They have to be able to identify those along the way over the years, or they're going to miss out grossly. If that doesn't compel you, then consider this. Since 1990, large cap tech has cumulatively outperformed the world equity index, the rest of the world, by 8 to 1. Okay, so it's a staggeringly compelling statistic over a very long period of time. So people have to go buy this market again. The question is, what's going to make them? And that's what we've been talking about for the past few minutes here. Let me roll forward to a little bit of AI. And I know you read a lot about this stuff, so I'm going to try to avoid repetition, but I've got a little bit of an interesting lens on this just because part of what I do with my time is I'm associated with a company that's building some of the largest infrastructure for the biggest AI training centers on the planet today. So I kind of have this daily sort of real-time stream of things coming at me in that regard. And, I've been doing this tech thing since before they called the internet the internet. We called it the DARPANET when I started paying attention to it. And in that time, I've never seen a tech war anywhere near this scale. It is staggeringly huge. And you need a really big balance sheet to pursue this. You got companies like Google with $100 billion of cash in their balance sheet, and they're spending tens of billions on this infrastructure with no sign of it abating anytime soon. There's a very simple reason why they're pursuing it with such vigor. And for those that, have looked into how neural nets are actually created, for the benefit of AI outcomes, they benefit from scale. So it's just a simple matter of having more high-powered computing nodes co-located in one facility. It just gives you a bigger brain, right? And that's kind of what everybody's after right now, is the biggest, baddest brain. Of course, you have to combine that with big data sets, and we'll talk about that in a second. But right now, that's kind of the raw scale war that's happening. Maybe we'll find a mathematical, theoretical way out of it where you don't need the scale a year or 2 years from now, but right now, scale matters. And so, the question is it just going to be Google and Amazon and Meta and people who could dump $50 billion into a data center infrastructure and the software and engineers to do that? Those are the only ones that win? I think the answer is no. There will be other ways to win. There are business models and offerings that you already see emerging that have lower scale dependence. I'll just give a few examples of this. It's not meant to be exhaustive. It's just sort of to stimulate thought. There are the picks and shovels, right? And so I mentioned Cerebras, a portfolio company of collectives. Really interesting offering. Right now they're using, the industry is using basically graphics processor units, that are sort of hopped up to go and compute all this. While Cerebras thought to themselves, why not make it wafer scale? And if you look at how semiconductors are created, they're creating these giant neural nets on these very large semiconductor platters. It's kind of a neat idea. And so you're going to see, I think, people who sort of supply the weaponry in the war and aren't looking to win the war. They're looking to just kind of benefit from the battle. So there's certainly the picks and shovels. There's AI enablement, right? Companies that aren't necessarily innovating the AI itself. But here's another great example, IntelliBase, another portfolio company of collectives. This is a company that for years has done an amazing job taking unstructured, forms essentially, and in an automated fashion through software and a lot of intelligence, creating structured databases out of it. And that saves an enormous amount of man hours and cost and speeds things up and does a lot of good things. Well, this business model, when injected with a good dose of AI, with a smart management team and engineering base, it just gets better and better, right? So they take that really successful platform they had from the past and they accelerate it with AI, which is nice to see. And you're seeing that in many instances. Then there's the vertical focus. I can't think of a better vertical focus than what we're going to see in bio breakthroughs in medicine. I mean, I'm not an expert in the area, but just as a kind of a cool thing to mention here, they recently discovered the first new class of antibiotics in decades. Not an antibiotic, a class of antibiotics. And the way they did this was they took 39,000 compounds and trained the AI model in their antibiotic efficacy and neurotoxicity to human beings, put it up against 12 million commercially available compounds, and used Monte Carlo methods in an AI net to basically find two that work really, really well in mice. And it's opening up a whole new class of discovery. And that's just one example. There's many examples like that, and they're just starting to do this. So there's sort of the verticalization of these specializers. Optimizers, you recently had Databricks come out with DBRX, a mixture of expert LLMs, where they are demonstrating that you can get high performance at lower scale, contrary to how I started this discussion. So you'll see folks doing that. And then things like offloaders and parsers. You had early versions of ChatGPT that looked quite brilliant until you asked it to do math, and then it was terrible at math. And so by parsing and offloading to math engines and similar offload technologies, you'll see AI cores get much, much better and smarter. And then finally, pretty neat areas like ethics tuners. One of the problems with AI models is that we're training it with, human-created data. So it's got the natural biases embedded in it from human beings. So a good example of that is credit scoring. Unfortunately, credit scoring data in the US, shows a bias against minorities. It's just a factual truism of the data set. And so there are university researchers such as UPenn that are coming up with things like challenger models to try to tease out that bias and not introduce a new bias into the data set. And that's important, because if you're a fintech and you're thinking about introducing credit scoring, through an AI engine, you have to be worried about that. Have I introduced a bias without even realizing it? So you're going to see people that specialize in these little areas that have big outcomes for these business models. Some of the obvious issues, what I like to call the charlatan. This is the person that roams around a cocktail party and, is, the handsome person who impresses by sort of knowing a little bit about a lot. And then you sort of take them off to the side for a substantive conversation and you realize they don't actually know what they're talking about. And so AI engines can look a lot like that at times. It's kind of funny because you go onto these publicly available AI engines and they often have these warning labels that are some variant of, caution, I might be an idiot. Please be careful how you use me. So, just to demonstrate this, Michael Sembelis, the JP Morgan economist that I referenced earlier, he actually, on GPT-4, and of course, we're much more advanced now, but on GPT-4, he asked it 71 questions related to his publication topics. These were broadly syndicated topics. They weren't very esoteric in nature. And the GPA that came out of that was 2.54 with frequent hallucinations. So as powerful as it is, we've got a long way to go. The second category is more alarming. It's the fake fill in the blank. We're seeing fake legal cases come about on the internet that are making their way into court systems. False articles in the public domain. We all have our favorite examples of fake things, but it's going to be, an industry unto itself, sort of identifying the fakes of AI. And then finally, model collapse or data exhaustion. The other thing you need other than just giant computing power is giant data sets. And so there has been a feverish attempt at just collecting as much data as possible and feeding it into these AI machines. And, it's not an infinite supply. And so at some point, when you keep sort of feeding it public information, you realize, hang on, a lot of that public information was generated by the AI bot itself. And so there's a feedback loop that gets created in all of this, sometimes called AI inbreeding, and that gets dangerous as well. So where will the new data come from? It's a great question to ask, and it's going to be an interesting battle to watch, particularly as the behemoths battle it out. Let me pause there because I don't want to crowd out my good friend Jake, and I want to leave time for Q&A. But we'll leave it at that for today.
Thanks, Phil. That's extremely interesting. But just to touch on or ask about a couple of points in your presentation, you talked a fair amount about your optimism, qualified, cautious optimism for the IPO markets. What about M&A exits? Do you see those becoming an increasing means of exit for companies that maybe aren't quite at the scale necessary for an IPO, but still in need of an exit?
Yeah, I think, again, qualified optimism there. I think there is the best examples I could give of M&A that works just beautifully is, two companies in a similar space, having adjacency to software companies as an example, where one almost bolts onto the other. A lot of examples of those where, one of the companies is perhaps a little later stage, more mature, has a great sales channel, 5,000 customers. And if they can pick up that bolt-on quasi-competitor, they eliminate an awful lot of costs, right? The G&A comes out, the sales and marketing comes out, you keep the engineering team, you roll it through your channel. It's the incremental profit off of that is amazing. And the reason those are encouraging is because even for companies that got quote unquote overvalued, there could be so much economic juice in that combination, it could overcome that value hurt, right? That's where you see a few examples where it works really, really well. Look, the tough ones are that difficult intersection that I talked about before, which is it's not just a high value, it's a high preference stack. So it's, investors put $1 billion into a company that might be sold for $500 million. What do you do about that? It's a painful exercise and a conversation for another day. That works less well. And then I'll just finally say that I think right now, we came out of this era where a lot of these, maybe older economy companies were in a little bit more of a frenzy of, I need some of the new stuff, right? And I think they've paused on that for now. I don't think they've exited it entirely, but they've gone through a digestion phase, and I think that's a little bit on pause. So I think the most robust part of the M&A market is where that more obvious fit intersection that I described initially.
Makes sense. Let me ask one more question, as you said, just to make sure we leave enough time for Jake's presentation. So obviously, you spend a fair amount of time talking about AI, but are there any other investment sectors or verticals where you think there is a substantial opportunity for investors?
Yeah, so I guess I'll make a comment on one broad, and then one that kind of surprised me a little bit. That's sort of more of on a renaissance. So I will say the classic software model, recurring revenue, NRR above 100%. I mean, it's just, it's I know at one point you roll back a few years, 10 years ago, and SaaS companies weren't the classic companies, and now they are. It's a great business model when it works. And I just think that those either need to grow into their valuations or already have in many cases. I think that's a very constructive market still, if you've got a robust offering in a good market, right? The one that surprised me though, because it's had fits and starts over the years, but this feels like it's a little more real this time, is the defense sector, right? Normally you don't think about Silicon Valley and the defense sector. It's just, I don't know, you've had a few examples along the way, intelligence companies, that kind of thing. Maybe cyber is a little too, but this is like weaponry, right? Or aerial reconnaissance you're seeing. And there have been a few private companies at scale, like Sierra Nevada is probably a great example of that, but they've been more founder-led. It's someone who's been doing this for 10, 15, 20 years, and they kind of built it brick by brick. Now you're seeing people go, all right, I'm going to take, AI and some drone expertise and some DARPA funding and get some, 20 million round from one of the, popular names out in Silicon Valley and make a go of it. And I think because of where the world is right now, unfortunately, right, it's a very turbulent world. I think we have a defense industrial complex that's much more open-minded to this kind of thing from the private sector. So, without, putting a good or bad label on that, it's fascinating because I've actually never seen it in my career emerge in a way that looks like it might be durable for some time. And some people are going to make some money on this, I think.
Phil, thanks for your time as well. I'm going to be looking into buying more Cerebras stock if it's at all possible, and great to see that you have, again, some qualified optimism for where the market is. Let's just hope the Fed agrees with you. All right, everyone. Thank you so much. Appreciate it.